Hello and welcome to the Q3 2020 review. And there's quite a bit to talk about. So we'll talk about two main things. We'll take a look at what the market's done and what I think that means. And then we'll talk about the elephant in the room with the election going on in the US. So first of all, we'll look at how the equity markets have done. So when I look at equity markets, I really look at four main areas to determine how it's performed. So the first one being in Canada, I look at Canada. So Canada, year to date, so as of September 30th, we're down 4.8%. In the US, different story, they're up 10%. In international markets, so that's other developed nations that you'd think of like Europe, excluding Canada and the US, they're down 4.3%. And in emerging markets, so this would be in the East, so China's included in this, they're up 1.8%. So really this reiterates the fact that in today's current climate, you need to make sure that you're well diversified. Having a portfolio strictly in Canada, you're still down on the year. Having a portfolio strictly in US, well, that's scary right now, and we'll look at reasons why. There's obvious reasons why with the election. And then just in international markets, you're down, and emerging markets, you added risk, but you are up. But the theme of this is that in order to have a proper portfolio, have a good, well-constructed portfolio, you need to be invested across all of these different classes. And then if we look at the fixed income side of things, if you've spoken to me in the last 6 months or so, you'll know that I'm not a fan of fixed income currently. They're paying very low interest rates. And then if you put it, the difference between a 3-year and a 5-year, even on the GIC side, is negligible. And it's very similar in the bond market today as well. Investment grade Canada bonds hold a very high standing on the world stage when it comes to debt. So we'll see in times of turbulence, you'll see a lot of money flood into investment grade Canadian bonds, which is a good thing. What that means long term though is that bonds year to date in Canada, the investment grade bonds have done 7.9%. That's high. That's higher than the bonds themselves are paying, and that's due to people putting money into them. But that has to come back. If you want to know a little bit more how bonds work, I will be doing a podcast episode on that that you'll hear more about in the future. But basically the theme is that bonds aren't looking so hot, and for the equity side of things, it paid to be in a very diversified portfolio. If we look at technology sector, that's the sector that has pushed the market in a upwards trajectory, but that doesn't mean that there still aren't opportunities out there to buy. It also means though that we don't want to be piling on to already expensive things, especially when we're in the midst of a transition. We don't know how it's going to shape out. We don't know what the world is really going to look like after COVID-19. Is Zoom still going to be as big as it is today? Who knows? So this wouldn't be the time really to be jumping on them bandwagon. Instead, we want to make sure that we have the fundamentals correct when we invest. I wouldn't say to be afraid of investing into the market now, but I certainly wouldn't be recommending putting it into high-flying technology stocks out there. Okay, now I want to talk about something that has been on everybody's minds. It's made up every part of every single conversation I've had over the past few months, and that's the US election. A lot of people are fearful either way, no matter which way it goes. I am not a future teller. I have no idea which way it goes. But I did want to touch on what's expected to happen, or what the analysts expect to happen, depending on the outcome. So a quick US politics lesson. There's 3 main branches to the political system. We have the presidency, we have the Senate, and then we have the House. Currently, the Senate is controlled by the Republicans, and the House is controlled by the Democrats. So there's 3 likely outcomes here. So first of all, we have the Democrats win across the board. So they win the presidency with Biden, they win the Senate, and then they win the House. Then we have Biden winning the presidency, the Republicans staying in power of the Senate, and then the House still being controlled by the Democrats. Or we see no difference to what we see right now, with Trump in presidency, the Republicans running the Senate, and the Democrats running the House. So I want to go through each one and talk about some expectations or what we'd potentially see if that scenario played out. So first of all, we'll look at if the Democrats win across the board. So likely we would see the corporate tax rate increase. We'd also see trade tensions reduce a little bit, which would be good for international markets, and the tax increase would be bad for domestic markets. Also, with Biden promising a massive bill towards clean energy, that would mean a lot of infrastructure spending in the clean energy space, which is already doing very well with the investors' new focus on sustainable investing. Now let's talk about if Biden wins and the government stays divided. So what we'll see is likely there will be attempts to increase the corporate tax rates, but it won't pass because the Republicans still hold the Senate. We would also see an attempt at least at regulating the technology, energy sectors, and healthcare. So that would be a negative thing to a degree for the stock prices of a lot of the companies that operate in these sectors. And one of the major things which we're seeing now would be because of a divided government, it makes it a lot harder to pass stimulus bills. And what that means is that it takes longer to provide the assistance that the businesses and large businesses, small businesses, the individuals need. So now if Trump stays president of the US, so markets tend to like status quo. They tend to like it when things aren't changing too much, and that probably will be reflected in the volatility of the markets. We'd likely see the tax rates remain the same. We'd probably see even more trade tensions. That's been a theme of Trump's presidency. And then also a theme of Trump's presidency was deregulation. So it's likely we'd see even more deregulation in the oil and gas industry, which should be good for the companies that operate in those sectors and would be reflected in the stock price. So overall, what does this really mean, and what does it mean for the portfolios? Well, as I've spoken about for a long time, it's so important to make sure that you're diversified across all different asset classes. There's no one particular asset class that we know for sure is going to outperform the others, or at least remain that way. We've seen ebbs and flows with different asset classes doing very well over the past 100 years. At some point it was steel, and other points it was oil. Recently it's been tech. There's always going to be areas of the economy booming, and there's going to be other areas that are dragging behind. And it's important not to get dragged along with the way money is flowing. So currently you see big names in tech just shooting through the moon, and it can be very attractive. It can look like you're missing out on something. Well, it's always, and there's not been a single time in history where that has reversed and it's come back to some type of mean. Currently, with all the COVID going on, we've been heavily reliant on technologies such as Zoom to talk. Even I use Zoom to have to do my reviews with you guys. What will that look like when people are back to work? Will it still be as useful? Will the stock still be as favored as it is today? I don't know. And if it's I don't like gambling. I don't do gambling. I prefer to invest in a solid thesis that over time has always done well, which is why you don't see me making massive plays into technology or recommending anything like that. It will always be to stick with what we know works over time. That's the review of the markets. It's been an interesting year. Can't wait to do the 2020 review. It's gonna be a lot to talk about there. But if you have any questions, feel free to reach out to me whenever you like. I wanted to point out in the future you will be seeing a little bit more educational pieces from me. I'm toying with the idea of doing some type of podcast. I think it's important. There's a lot of aspects of the finance world that people don't understand fully, and I think it's a really good way to have bite-sized little learning pieces. So anyway, let me know if you think that would be a good idea. I'm thinking like maybe 15-minute, if not less, little episodes covering anything from the way bonds work and how they react to interest rates, to what beta is, and reaffirming what risk is and how to understand your own risk tolerance and things like that. I think there's a lot of little bits that maybe I can use to to educate. But anyway, let me know your thoughts, and if you have any questions, feel free to reach out to me. Thanks.